managers. Samit, hi, morning. Great to have you today on ET Now. Samit, from the March lows, price-wise, we've come a long way, both on the Nifty, the mid and the small cap indexes, and more importantly now with the crude cooling off. Various asset classes like Bitcoin, gold and silver, we've seen what's been playing out. While prices have definitely rebounded, I want you to talk a little bit more about whether sentiment has truly or not.
Right. Good morning, Aisha. Yes, I mean, sentiments, I think they're still jittery, because there is so much of uncertain things change on a daily basis. We have rebounded from the lows, but, if you look at our highs, Nifty is still 9-10% away from where we had reached maybe in September 2024. Right. So in that respect, I think, the sentiments are nowhere close to what, we can call bullish. But, I do believe that the drag for India, which was mainly the crude, I think the worst case scenario probably, are out. We don't even know, if things will, hopefully things will get better, but, there is no certainty of that given, Trump in the leading position, and then with Iran where things change very very quickly. But overall, I think I'm most positive because of the earnings that we have had. If you look at the last quarter, the small cap median earnings growth was close to 25%, and even for the mid caps it was around 20 to 23%. Large caps was below 20%, but still around 18-19% in terms of the median earnings growth. There could be some, drag because of the crude price inflation. But again, I think investors would know that this will be a transitory phase, and probably it may have an impact for a quarter or two. But I think investors would always look, 6, 9, 10, 12 months beyond that. So on ground, I think things are not that bad. I think we only think about negatives, but there are all, there are a lot of positives also, because when the currency drops, a lot of export-oriented sectors, do well, and I think we will see the tailwind behind them. At the same time, because of the inflation in crude, a lot of companies would have taken price hikes. But most of these companies will not take it down when the crude prices go down and then the cost pressure go down. So a lot of companies may make up, pretty significant improvement in margins, going forward. And that's how things work. I mean, we have seen same thing play out during, post-COVID times when commodity prices, a lot of, prices went up, and then, companies took price rise. But when things cooled down, no one really took it down. So I think similar probably phase will play out over the next few quarters. So overall, I'm positive. I mean, but there is no way we can relax and say that things are settled.
We can never do nowadays, always on tenterhooks. But Samit, I recall in May, you were one of the first ones to stick your neck out and saying that sentiment will now change, and especially for the mid and small caps. You said that, the worst is behind us. The worst definitely seems to be behind us when it comes to the way mid and small cap indexes in particular have performed. And I'm not even talking about individual stocks. Are we still in that sweet spot for stock picking, specifically in mid and small caps?
Yes, I mean, see, what happened during March, April was that, our small caps and across the board, I mean, large cap, mid cap, everything, dipped. But one key trigger, which was, very, very convincing for me, was that the price to book of small cap index, fell below the 25th percentile compared to the last 5-year average, meaning that we were in the lowest 25%, of the last 5-year average, which rarely happens. It happened during the COVID month, which was March month. Right. So I think for me, price to book is a much better multiple compared to the P multiple. P multiple tends to be very volatile. For example, today, investors do focus on a lot of AI-based stocks. So for example, Samsung or Hynix, which those are the two stocks which have taken the Korean market high. right? But their earnings is very high, no question about it. Question is, are these sustainable, right? Because after all, these are commodities, even though they may be high tech, but they are still commodities. And when there is high demand, the earnings really shoot up. But 3 years, 4 years down the line, the earnings may be 20% of where they are now. So if you look at their price to book, right, price to book of Hynix today probably is 10, 11 times, Samsung is 5 times. And if you look at their historical price to books, it used to be 1 time or 2 times, right? So when you look at the price to book, the valuations are extremely expensive in those spaces. But for some reason, investors always are stuck with P multiples, and sometimes P multiples are very misleading. So for India, I do believe that price to book for small caps are pretty reasonable. They are definitely below median of the last 5, 6 years. And more importantly, is the earnings growth has picked up. I think earnings growth momentum will continue irrespective of what happens with the war. Because small caps aren't that much impacted by geopolitics. And the valuations are reasonable. So I mean that keeps me still pretty positive about that space.
Uh, we've seen many of the Indian IT companies acquiring companies with AI capabilities in an effort to bring in the scalability in the entire revenues. And we recently saw Persistent also acquiring a big company in European markets, though it's a highly leveraged buyout which is coming in. How do you look at these companies? The top tier was going on a slow track with respect to growth, and companies like Persistent and others had a better growth rate. Do you think that acquisitions based on balance sheet strength or leverage will be rewarded by the street?
Yeah, I think what happens is that there is investor pressure, for these companies to sort of, you know, evolve, and then during this phase of evolution, the companies do try multiple things, and it may not be something which is highly predictable. Some acquisitions are highly uncertain, because the integration, and it's a new growth avenue for them. So I don't think even the company probably would have high conviction predictability going forward. So for investors like us, I think it's even worse. Right. So I would definitely take these acquisitions with a pinch of salt. These are high risk. If it plays out, yes, it can really give you big delta. But I'm not so sure about this.
Samit, let's talk a little bit about sectors as well. You've spoken, beautifully about how should one look at the small caps, price to book being the better metric, and thereafter look at earnings growth from here on. What sectors are you bullish about within the small cap basket? Is there a sector tilt?
Yes. See, today what's happening is, there are sectors which people are excited about, right? So, for example, anything to do with power equipments, power ancillaries. But unfortunately, the valuations are crazy. Same thing is with defense, right? So if you look at all the frontline defense companies, they trade at 70, 80, 100 times kind of a multiple. Historically, if you see, their multiples used to be, barely 10, 20 times. And hence, any attractive theme, is super expensive. And the themes which are not delivering on growth, or if there is no excitement, those are the ones which are, available at really cheap valuation. It could be, financials, it could be, maybe some part of IT, right? But there is a lot of uncertainty and there is no growth available. So you're sort of stuck, between hard places. So for me, it's all about stock picking. The sectors that I like today, I think, which will benefit. One is, of course, export oriented, which includes textiles, because of newer markets opening up for textile. Specialty chemicals, including sort of CDMO, is that I like. Export oriented defense, that's also something that I like. I like co-working, the managed spaces space. I like gold finance. I like some of these NBFCs, right? Where the key for me is at least 20% growth, 20% plus growth. But if you look at that space in the larger companies, it's still expensive. But you come to the small cap space, there are so many IPOs which are coming up in the power ancillary space, which are trading at 10, 12, 13 times multiple. Whereas if you look at the already listed plays, they're all trading above 50 times kind of a multiple. Same thing is with specialty chemicals, So I think it's picking the right theme or space is not good enough. Picking the valuation within that is also important. And the reason I am positive about small caps is because that's the space where you do have the growth as well as valuation kind of a combination, and which is not really available, in the frontline kind of names, which are pretty well known to everyone.
Samit, how much of a concern is cash flow? You're talking about small caps, and we've seen that as a perennial problem, that while growth will be 40, 50%, if cash flow isn't coming through these days, the street is a little bit cautious with regard to rewarding some of those stories. How should one differentiate the winners from the losers from a cash flow standpoint?
Yes, I think, that's a metric which has drastically changed, from the pre-COVID level to now. For example, if you look at the operating cash flow of the small cap space, previously, operating cash flow to PAT ratio, this is something that I do track. It used to be below 1. It used to be, somewhere around 85 to 90. Today, that's at around 115%. So in terms of operating cash flow, definitely things have improved. I mean, because the working capital cycle has shrunk. If you look at a lot of small cap companies, used to have 35, 40 of working capital days. Today, it's fallen below 20 days. And that's where, because of the operating cash flow having picked up post-COVID, the debt to equity has fallen because they have used a lot of that cash flow to pay off their debt. So today, the debt to equity ratio of the small cap space, the median used to be 0.5, 0.6. Today, it's at 0.1. So there is significant improvement, and that's what has improved even the return on equity. If you look at the return on equity of the small cap space, used to be between 9 to 11, 12 times, 12%. Today, that's close to 15%. And I think that will only improve going forward. So I think a lot of investors are missing this key change which has happened in the small cap space. The quality of earnings has definitely improved significantly. And I think that's the reason they also deserve a little bit better price to book and as well as the valuations.
And Samit, even within the power space, the power transformer space, you've got some very strong growth stories out there, very good visibility with regard to order books, but and some of those, maybe a couple of those stories, trading at maybe 10 to 15 times. Is that the pack also which is looking interesting to you?
Yes, that's also a very interesting space, I think, but one needs to be careful because there is too much of capacity which is building up there. So there is fear of overcapacity which is also building up there. So I really like that space. One has to but take the right position where, because there are different types of transformers, some on the power production side, some on the distribution side. And one needs to see, which pocket has less competition coming up, going forward. And accordingly, even if you were to buy it a little higher price or, P multiple, it's better to look at space where there is less competition.
Okay. Samit, so you've given us a real nice broad-based view of how you're looking at things you like and things you don't. I don't hear, for example, healthcare, where there is growth, but likely valuations are pricing in some part of that growth. How are you looking at healthcare as a pack, hospitals and the like?
Right. Yeah, I mean, it's a really nice space, but I would categorize that into the same, where it's an exciting space, high growth space, but valuations are not attractive enough, for investors like us to go in, because for us, we do need both of the combination, which is high growth as well as reasonable valuation. And for me, reasonable valuations, I need to be very, very conservative in this kind of times, uncertain times. And hence, even though I like a lot of themes, but many of those themes are not available at the right multiples.
Okay, Samit, so great having you on the show and, got so many insights on how to look at the markets right now. Thank you for your time.
My pleasure. Thank you so much.